Hello everyone, it is your financial coach Donna, and I want to welcome you back to Growing My Wealth with Donna, a place where we're changing our mindset about money and increasing our wealth. You know, I always like to start my video with a question. Today's question is, do you know what percentage of adult Americans own stock? Please stay tuned and I will answer that question shortly. If your answer was in the neighborhood of 55%, you guessed correctly. This percentage is based on a Gallup poll conducted in the first quarter of 2020. This illustrates that roughly only half of adult Americans own stock. That percentage is considerably lower for people of color, between 30 and 40%. Consequently, nearly half of the U.S. population is not invested in stocks or the stock market. This means half of the country cannot take advantage of the capital gains income, which is one of the key streams of income that drastically impacts the net worth of the average American's household. So, if you are in the 45 percentile of the people who do not own stocks or invest in the stock market, you will find this video very helpful and informative. Today, I'm going to focus on the basic principles of investing and familiarize you with key terms used in the world of investing. First, let's define what investing is. According to Investopedia, investing is the act of allocating resources, usually money, with the expectation of generating an income or profit. You can invest in endeavors such as using money to start a business or to purchase real estate in the hopes of reselling it later at a higher price. Investing is a way to set aside money early in life and have your money work for you so you can fully reap the rewards of your labor in the future. The goal of investing is to put your money to work in one or more types of investment structures with the expectation of growing your money over time. The legendary investor Warren Buffett defines the investing as the process of laying out money now to receive more money in the future. The two key words that I do not want you to miss are over time. Consistency over time is key to building wealth. Also, starting to invest early is very important. The earlier you start, the better off you will be. However, financial experts recommend that you are completely out of debt and have 3 to 6 months worth of expenses in an emergency fund before starting to invest. This will give you a solid financial foundation just in case an emergency arises. Many years ago, my husband and I had to pause our investment contributions due to an unforeseen circumstance which required us to switch our priorities to rebuilding our emergency fund. So believe me, it is imperative that you have an established emergency fund to prevent needless delaying or stopping your dreams of investing. Now that we know what investing is and the importance of investing over time, let's discuss some basic investing terms. The first term is broker. A broker is an entity that lets you buy and sell investments for yourself. Usually you pay a fee for this service. There are also plenty of online discount brokers. With online discount brokers, you often pay a flat commission per trade. Some companies even offer free exchanges. Another term you will hear often is brokerage account. A brokerage account is created by a licensed brokerage firm that allows you, the investor, to add funds and place investment orders. The investor owns the assets contained in the brokerage account and usually has to claim any taxable income from capital gains. Many companies allow investors to set up accounts online. Have you heard the word stock? A stock, also known as equity, is a security that represents the ownership of a fraction of a corporation. For example, when you, the investor, buy stock, you become part owner of a corporation. Think of stocks as a very small piece of the company. When you purchase stock in a company, you are now called a stock owner. This entitles you to a proportion of the corporation's assets and profits equal to how much stock you own. Units of stock are called shares. There are two main types of stock: common and preferred. Please feel free to Google these two types of stocks for additional information. Another investing word you may hear is bond. A bond is a fixed income investment in which an investor loans money, typically to corporate or governmental entities, for a defined period of time at a variable or fixed interest rate. There are many types of bonds out there. Please feel free to do more research. Now, you may have heard the term mutual fund. A mutual fund is a pooled portfolio. The fund itself holds the individual stocks in case of equity funds or bonds in the case of bond funds. Mutual funds are a great way to get exposure to groups of stocks or bonds, but be careful. Many have high fees that can eat away at your returns. Another term you will hear often in investing is index fund. An index fund is a mutual fund that allows individuals to invest in an index such as the S&P 500. Index funds are very similar to how mutual funds work, but typically have very low fees and are better. Have you heard someone use the term ETF? ETFs are exchange traded funds. They are like mutual funds, except they are traded throughout the day on the stock exchanges like individual stocks. ETFs can hold various assets like stocks, commodities, or bonds. The last terms you probably hear a lot on the daily news are S&P's 500, the Dow, and NASDAQ. These are indexes that give you a quick summary of how the market is doing. It will show if the market is growing or climbing. So the Standard & Poor's 500 mirrors how the 500 largest companies are performing, such as Apple, Google, and Johnson & Johnson. The Dow Jones Industrial Average monitors 30 big companies like Disney, Google, and Coca-Cola. The NASDAQ follows over 3,300 stocks from tech companies such as Zoom, Netflix, Facebook, and Amazon. So, when you hear the Dow is up or the NASDAQ is down, you can get a pulse on how the major companies in our country are performing. Now, you're probably asking, how do I make money in investing? With stocks, you can make money through dividends. A dividend is a sum of money paid regularly, typically quarterly, by a company to its shareholders out of its profits. Keep in mind, not all companies do this. Your dividend will go into your investment fund. The second way to make money is to buy a stock and wait for its value to increase. I highly do not recommend putting all of your money into a single stock. That could be dangerous if that company does not perform well. You want your portfolio diversified and balanced. When the company grows and becomes more profitable, their stock value increases over time, which means your stock is now worth a whole lot more than what you originally paid for it. Your next question is probably, how does my money grow when investing? It is called compound interest. For example, let's say you bought $100 worth of Disney. Now you make about 10% on that. Your stock has now grown to $110. Next year, let's say you make 20%. This means that you make 20% not on the $100 you invested, but on the $110 that it grew to. Let's say the following year it makes 15%. Now you're making money on money that you have already made. Isn't that amazing? Compound interest is a great thing. When investing, always remember, past performance is not guaranteed for future results. On a positive note, as you can see, investing can be instrumental in growing your wealth. Are you now excited about investing? Today, I have provided you with basic investment terms to help you get started on your investment journey. I hope what I shared today will get you motivated and ready to start investing. Remember, no matter what age or stage of life you're in, it is never too early or too late to invest. As always, thank you so much for watching. Please leave a comment, click like, and subscribe below. Have a wonderful day.